African mining is sitting on billions of dollars of potential capital, and most of it never even gets a chance to look at the sector. Not because the projects are bad, not because the geology isn't world class, not because Africa lacks opportunity, but because African mining was never designed to speak to the people. It was built for institutions. It still talks like institutions, and that model is now structurally outdated. Today, we're talking about the capital that African mining companies keep leaving on the table, specifically why African mining is structurally dependent on institutional capital, how that dependency quietly creates valuation discounts, and why retail capital remains one of the most misunderstood and underdeveloped growth levers in the sector. Don't get me wrong, this isn't about hype. And it's not about turning mines into tech startups. This is about capital structure, the power of building a strong narrative and long-term value creation. Welcome to AfriTenacity. Here's the uncomfortable truth. African mining was never built for the individuals. No, it wasn't. Yes, we're starting off with a truth that might make professionals uncomfortable. But the current state of African mining is not designed to be understood by everyday investors. It's designed for development finance institutions, major banks, private equity, large mining houses, sovereign partners, and the system just simply assumes technical fluency, long attention spans, access to insiders, and a background in engineering or mining. See, with all of those assumptions, retail investors were never the audience. They were, at best, an afterthought. And because of that, the sector developed a language, a culture, and an investor relations style that actively filters out people. Not intentionally, no, but structurally. Let's take a moment to discuss why mining investor relations fail retail capital. The first reason is mining investor relations language is way too technical. Mining companies often communicate like they're writing internal reports. They use GORC codes, resource categories, metallurgical recoveries, I can't even say that word, strip ratios, feasibility acronyms, stacked on acronyms, and all the technical correctness that they can find. All of this is very well and professionally necessary, but to a retail investor, it sounds like shoo. This is not for you. Retail investors don't need less accuracy. They need translation. The second thing is that mining investor relations is too defensive. Most African mining communication is built around risk management. You hear regulatory risk, political risk, currency risk, infrastructure risk, ESG risk, and yes, these risks do exist. And as an accountant myself, I understand them all too well. But when risk becomes the entire narrative, belief in what the companies are trying to achieve just simply disappears. Institutions tolerate that because they paid to manage downside. Retailers, on the other hand, they invest when they believe in the upside. The third thing is that mining investor relations are too opaque. Here's the quiet part that no one actually says out loud. Many retail investors want exposure to African mining, but they just don't know how. They don't know where to start, which companies are credible, how many projects are actually scaling, or what success looks like over 10 to 20 years. By being so cryptic, miners might think that they are basically protecting the value of the company. But to a retail investor, this looks way too complex. It takes time for them to actually consume all that information, and it just doesn't seem worth their investment. In short, being unclear repels what retail investors could actually believe in. If the African mining sector ever wants to be inclusive and attract retail investors, there's two different types of capital logic to actually consider. There's the institutional and the retail investors. So institutions optimize for risk minimization, capital preservation, quarterly or mandated performance, exit optionality, and institutions are very, very defensive by design. This is not a criticism on the institutions. No, it's their job. Retail investors, on the other hand, optimize for the narrative, the vision that the company has, believing that we will actually get there. Long-term asymmetric upside. And retail capital is patient. It's emotional, yes, but it is very much identity-driven and willing to endure volatility because they can believe in that mission. This is not dumb money. This is belief capital. According to JP Morgan analysts, at the end of 2025, the amount of cash retail investors poured into the US stock market in 2025 was up 53%, from about 197 billion when compared to the prior year. And it was 14% higher than the 270 billion record that was hit during the height of the retail trading frenzy in 2021. And African mining barely reaches these investors. You know, the hidden cost of capital left on the table is often not even measured by the industry. When mining companies ignore retail investors, they lose liquidity depth. When liquidity is thin, narratives are weak, and retail participation is absent. Then, markets apply a valuation discount, not because assets are poor, but because belief is fragile. Furthermore, when retail is ignored, the company loses brand loyalty, long-term shareholder stability, narrative momentum, valuation resilience during those downturns, and retail capital doesn't just bring money, it brings attention. Attention attracts analysts, which then attracts partners, and then those partners attract future institutional capital. Retail investors are often the early signs, not the end game. I go further into details about this on another video which I've linked in the description down below. Here's why African mining is perfectly positioned to capture retail capital, but currently it's missing it. African mining has everything retail investors respond to: massive future demand, critical minerals, infrastructure build out, nation building impact, long-term global relevance. But we at AfriTenacity know that this is a generational transformation. Instead of saying it just as it is, it gets framed as, here are the risks, proceed carefully. And that's the biggest mistake, because the framing literally leaves capital on the table. And the thing is, we already have a well-documented template and proof of concept of how to bring retail investors into the fold. Think back to early 2022. This was before COVID pandemic hit the world. But something quietly was brewing. Tesla retail investors were just getting started. In another video that I've linked in the description down below, I will share the full analysis of the role retail investors played in making Elon Musk one of the world's richest men for consecutive years. To be clear, we're not trying to turn mining into Tesla, no. But Tesla proved something critical. Retail investor belief can fund long-term vision, absorb volatility, and sustain valuations through uncertainty. And another thing is that they could force institutions to follow suit. Tesla didn't win because it was risk-free. No, It won because people believed in the mission, the future, the story, and African mining doesn't need all that hype. It needs translation plus vision plus long-term framing. Tesla is the proof of concept. Our view is that African mining doesn't have a capital shortage. It has a communication and belief gap. And our role is simple. Translate mining for people, bring retail capital into conversations without dumbing it down, build a bridge between professionals and the next generation of investors. Because the future of mining in Africa will not be funded by institutions alone. It will be funded by individuals who believe in the future of African mines, and belief starts with understanding. Here's the uncomfortable truth. Everything that I just explained is completely useless if African mining doesn't understand how retail belief actually gets converted into capital. Because there are 3 specific mechanisms that turned Tesla from a risk idea into a capital machine. And if you missed even one of them, retail investors won't fund your vision. They'll just watch from the sidelines. That's exactly what we break down in the next video. So watch now, because this is where the theory turns into capital. If you have found any of the information that I've shared to be valuable, please subscribe to the channel and share the channel with those who need to hear this message. I'll see you on the next one.